Welcome to the show, Matthew.
Thank you for having me, Mo.
Matthew is a 24-year-old investor located in the Greater Toronto Area. Obtained his Master's of Accounting and BBA from the 𝗖𝐋𝐈𝐖𝐊 School of Business from York University. And also, most recently, about 3 to 4 months ago, if I'm not
Yeah.
mistaken, he obtained his CPA designation. So
Yeah, I was lucky to go to a business school, and I think I learned a lot of financial literacy from being in those programs, and it's something that's helped me in life, whether it be with saving and investing young. I feel like it's something that's not really covered or discussed as much in the high school curriculum and whatnot. So I thought it'd be something that would be nice to share with people because I think a lot of people are interested in maybe starting investing or starting managing their own money, but they're a little bit intimidated because they don't have the foundation. So I started posting on Blossom around the new year, January, and I was surprised to see like how much interest my posts generated and how much engagement there is, not only on my feed but just on everyone's feed. Like everyone's super friendly. It's a great place to learn and learn from other people and share what you know. I started off like a lot of people would DM me questions, and it was a little bit difficult to answer to the questions on DMs. Like typing on your phone and whatnot. There's no
oh,
edit feature, I know, on Blossom, so you make a typo and you're like, oh no,
oh yeah.
it should have been a different number or something. So I had the idea of maybe creating a Google form, and that's what I posted a few days ago, where you sort of give me a little bit of information about yourself. Are you a student? Do you have a rental property? Are you retiring soon? It gives me a little bit of an idea of like your profile and what might be applicable to you. And then I've sort of put together these packages that give relevant advice based on your own financial situation. And then, of course, there's a section at the bottom where if you have, any specific questions that aren't covered in there, or you really want to know about a specific topic, you can sort of write me a note in there, and I've provided those services for people. I didn't expect to receive as many requests as I did, and I was pleasantly surprised. I've done a few, maybe 10 in the past week or two. It's kept me pretty busy on the weekends. So,
I'm sure. Yeah.
uh, yeah, so it's a service that's available there, and the links in my bio on Blossom. And for me, it's been a great experience too because I'd say maybe 75% of the time I get a question, I know the answer, but there's always that one where I'm like, well, that's a great question. I have no idea what the answer is, and it forces me to do a little research and expand, my knowledge. And then it's a great thing too because it sort of gives me an idea of what the community might be wondering in general. Like obviously you see repetitive questions, and then that obviously feeds into the posts that I make, and it helps me sort of get an idea of what posts I should be making, because a lot of the time the questions do repeat themselves.
So maybe I'll touch on my question first and we get started because I know in my channel there are folks that actually follow the Smith Maneuver and they're
Mhm.
interested in that. I reached out to Matthew because along the journey I learned a little bit more about the return of capital. And for folks that followed my journey, they know that I like to keep things simple. So we invest a lot in 𝗖𝐋𝐈𝐿, which like many other sometimes all-in-one ETFs, they tend to mainly focus on growth. They do pay a modest dividend. In this case, they pay a quarterly dividend, but part of the amount that they pay you back as part of distributions, at the end of the year, they announce some sort of a return on capital. And I was reading a little bit about it and I was getting freaked out. I was like, okay, all right. So it's very hard to keep track of it.
You can deduct interest on funds that you borrow to invest as long as you have a reasonable expectation of generating taxable income. So there's a few key words in there. First of all, it's taxable income. So if you're holding these investments on the borrowed funds in a TFSA or RRSP, even an FHSA, you won't be able to deduct the interest. It's only for investments held in a non-registered account where your income is going to be subject to tax, which makes sense because it's like you borrow the money, you invest, you generate taxable income. The cost of borrowing that money to generate the taxable income, you can sort of offset some of it. So that's one key consideration. And then income, the CRA, it needs to be dividends or interest. So if you're investing in sort of an asset that doesn't pay dividends, you wouldn't be able to write off the interest. You need to be generating one of those two. And then a reasonable expectation as well as a key term. So you don't necessarily have to generate income. Just when you make the investment, you have to have had a reasonable expectation. So, like for example, let's say you invested in Bell Canada or something, and they go out of business, or they say we have a lot of debt, we have to stop paying dividends. When you invested, you had the expectation that you would receive dividends. If you don't, for any reason, you can still deduct the interest. So that is, in a nutshell, interest deductibility. And now you mentioned return of capital. So, return of capital distribution, maybe I'll explain a little bit of what it is for the audience. some funds have like such a high target yield. Maybe they're yielding 10%, 8%, and a lot of investors might be attracted to these funds because they provide like guaranteed income and predictability planning wise. Sometimes maybe the investment might not perform as much to generate as much income that is required to pay out such a high yield. So what the fund will do is they'll return the investor a portion of their initial investment. So that's called a ROC distribution, or a return of capital distribution. So the CRA doesn't view that as income because it's just a return of the money that you put in. So if you invest in a product that pays you out a ROC distribution, you wouldn't be able to deduct the interest on borrowed funds. There's one caveat in researching for your response that I came across. If you get a ROC distribution and you reinvest it yourself, then you would still be able to deduct the interest on borrowed funds. And then one other consideration, I know you said you like to keep things simple, which I agree with, and you invest a lot in 𝗖𝐋𝐈𝐿. I know it has a small yield, and I'm sure a lot of it isn't a ROC distribution, but if a small portion is a ROC distribution, you're pretty much good to go to deduct that interest still. The CRA is not going to make you prorate your interest deduction just for a small portion of that total distribution being a ROC. Obviously, if you have a portfolio and maybe if half of your distributions are ROC and half of them are true dividends, true income, the CRA might make you prorate the interest so that only half of your interest charges are deductible. So there's a little bit of flexibility in there. It's not to say that if you have a portfolio that's generating a half of the distributions as in the form of ROC distributions, that none of the interest would be deductible. But those are a few considerations along those lines. So reasonable expectation, taxable income.
This
And
is
then
very
you,
helpful, Matthew. Yeah, so for folks to know exactly what are some of the consideration behind it, because like I can imagine like there might be some folks that are like, yeah, this is great. Like maybe I'm just gonna go for a Smith maneuver and then maybe start buying some of these funds that are very very high yielders. Like
yes,
oh, I mean
the
on
covered
paper it
call
sounds great, but
funds,
yeah, should be
the
cautious of
yield
that.
max, the high
Yeah,
yield, like those are the ones
yeah.
that, when you see a fund returning like a 60% or 30% distribution,
Mhm.
chances are a lot of that is a ROC distribution. And then one other thing on the ROC distribution, they aren't taxable because it's just the return of your capital. What it actually does is it defers the taxes. So your adjusted cost base for that investment is going to be decreased by the ROC distribution. So if you invest $10,000 into a fund, it grows to 12,000,
Mhm.
and during that period of time you got a ROC distribution of 1,000. Your cost for that investment, your true cost, drops from 10 to 9 because you returned 1,000 of your initial investment. So while that 1,000 when it was returned to you isn't taxed, it's going to increase your capital gain down the line. So ROC distributions tax aren't tax free, they're just tax deferred in a sense. They're
In
deferred
other
by.
words, it would adjust your adjusted cost base. Is that fair to say,
Yes.
Matthew?
So adjusted cost base, it's one of the more tricky things to sort of track on your own, especially if you're buying frequently at
Hmm.
different prices, and you add in the complexity of maybe
Yeah.
fractional shares, making
Ooh,
it
yeah.
even more complicated. It's something you should do for all your investments, because while you're provided a T3 slip from your brokerage, it's good to always double check that they're doing the calculations correct. If you're not getting ROC distributions, chances are it's pretty you're pretty safe. But if you get ROC distributions, it's something I definitely recommend, because every time you get a ROC distribution, you should be decreasing your adjusted cost base. Yeah.
In simple terms, Matthew, so let's say, because like in this case, I believe you would know the ROC distribution for like a fund such as executive, even if it does pay dividend on a quarterly basis, you would know the ROC distribution at the end of the year once they have their
Yes.
financial kind of announcement. Would you then take that amount, and in this case, I believe it's only a few cents, take that amount and kind of take into account the total number of shares that you had at the end of the year and kind of take that as a rough estimate? Is that how you do
Yeah.
it?
So you can track your adjusted cost base for your entire position, or you can track it on a per share basis.
Other important topics that so far you've heard from many of the folks that have reached out to you. One of those, and kind of resonated with me as well, was around withholding tax. Speak to it.
Withholding tax for sure is the most common topic. I probably get one or two questions every week about the withholding tax, and I see them in all the posts of people like debating, where should I hold this U.S. investment? Is it So maybe we can start with what the withholding tax is. So a lot of countries charge withholding taxes on residents of other countries. So if you don't file a tax return, like me and you don't file US tax returns, but we might invest in companies that pay US dividends.
Hmm.
Obviously, the US wants to generate some tax revenue on income that's sourced in their country. And because we don't pay US tax returns or file US tax returns, the way they do it is through a withholding tax. So they take off currently 15%. The US usually charges 30%, but Canada has a sort of treaty with them to lower it to 15%. So 15% of your yield is cut before you even receive it, and that money goes to the IRS as a withholding tax. A lot of people ask me, should I put money aside at the end of the year to pay this withholding tax? So the good thing is it's actually taken off the top before you even get your distribution. So there's no need to put money aside or worry about owing, 15% of your US dividends back at the end of the year. Um, One good thing that Canada and the US has as of now, I don't know if they'll have it in a few months, is there's the exemption for investments held in your RSP. So if you have money in your RSP and you have it in a US equity and or even a US ETF and they're paying you a distribution, the withholding tax rate is zero versus 15%. So that's where a lot of like the questions come from people saying, I have this US investment. Should I hold it in my TFSA? Why would I ever hold it in my TFSA? Why would I ever want to pay a withholding tax when I can simply avoid it by holding the investment in your RSP? So what people I think need to maybe look at first and consider is whenever I'm looking at where to hold my own investments, if it's a growth investment, I'm going to hold it in my TFSA, and if it's an income investment, I'm going to hold it in my RSP, regardless of uh, or not regardless, but I'm going to hold that as my primary point of analysis before I look at the U.S. withholding tax. So I'll give you an example. Like Apple has a distribution yield. I looked at it before this call of about 0.5%.
Hmm.
So after the withholding tax, if you take 15% off of that, it's going to be 0.425%. So if you have $10,000 invested in Apple, you're going to get $50 dividend if you hold it in the RSP, or you're going to get $42.50 dividend if you hold it in the TFSA. So it's a difference of $7.50. So yeah, you're going to have to pay that by having it in the TFSA. But I looked at Apple's return over the last 5 years; it's been 153%. So in your TFSA, that entire gain is going to be tax free when you go to sell it. In your RSP, when you sell an investment, the capital gain, it gets added back to your income and taxed at, like, it's fully taxed at your marginal tax rate. So while you could have avoided that, $7.50 withholding tax each year, um, it would have been much better to hold it in the TFSA because it's a growth investment. But then when you look on the flip side, there's certain investments that you might be making just for the yield. Like some examples I came up with was if you look at Johnson and Johnson, they have a 3.35% yield, so much higher than Apple's
Hmm.
0.5%, about like 6 or 7 times higher. And then you look at their 5-year return, it's just 5% over 5 years. So you would have probably been better served to hold that investment in your RSP where you get the full dividend without the withholding tax, because the gain on an investment like that is you're holding it primarily for the income.
Hmm.
Another example is even Pepsi. Pepsi's stock's been flat over the last 5 years. It's generated, I think it might actually be down over the last 5 years, whereas like the yield's over 4%. So that's a more significant yield where the withholding tax is a little bit more. It's advantageous to try to avoid it by holding in the RSP. So you should primarily look at if is this a growth investment or is this a yield investment, an income investment. If it's a growth investment, I would hold it in the TFSA regardless of whether it's US or Canadian. That's now under the 15% withholding tax. I know you alluded to potential increases
Are we
coming.
going to get a tariff on dividend income as well?
So the US, from my understanding, and I know things change by the hour down there, uh, they passed a bill in the House and now it's up for consideration in the Senate. They want to increase the withholding tax from 15% to 50%. So that's obviously a big sort of jump. Over 3 times the tax would be applied to that. So that changes things a little bit in the sense that now these investments that you might have been okay paying the withholding tax on in your TFSA, it still, in my opinion, doesn't really make a difference because even Apple, like, okay, you get $50 versus $25
Hmm.
now. it's still worth it holding in the TFSA. But now another rumor I've heard is that they're potentially looking at ending the RRSP exemption.
Oh, wow.
So you wouldn't be able to sort of shelter those investments and avoid the withholding tax in the RRSP. So that also, obviously, we need more clarity on what is going to happen with that bill, but that would sort of change the calculus on your planning. But we'll see. I don't know if it's the best idea for them to increase it at 50% because obviously they want to generate more tax revenue and fair enough. And if you can get citizens from another country to sort of pay more taxes, like
Mhm.
any country around the world would would like that. But then there's also a theory in tax. It's called the Laffer curve. It was designed by Arthur Laffer. He worked in the Reagan administration. And the idea behind that is that if you have a low tax rate or you have a very, very high tax rate, you might generate less tax revenue than if you have a tax rate that's sort of in between. So the idea, like, and I'll give you an example. If Canada were to put a 0% tax on crypto, like a lot of people would want to invest in crypto, but there would be no tax revenue. If they were to put a 90% tax on crypto, they'll be making 90 cents on every dollar, but still not a lot of people would want to invest at such a high rate. So a more reasonable tax rate is something in between. So it's sort of the idea is that the tax revenue is like a parabola
Mhm.
where there's like an optimal rate in between. So going from 15 to 50, I don't know if that's such a large jump. What they might not account for, and like you've seen it even with the response to the tariffs, the way now when Canadians go grocery shopping, the
Mhm.
sort of the
Travels,
boycott
yeah. Yeah.
of U.S. products, even on Blossom. I don't think it's the smartest thing financially, but you already start to see people
Mhm.
pushing back, saying like, why do I have to hold J.P. Morgan when I can hold RBC, or why invest in Exxon when I could invest in Enbridge? So I don't know if they've fully accounted for at a 50% tax rate if it's gonna people are gonna say I'd rather not hold this investment at all.
Mhm.
So that's from something else I've noticed on this issue. But it'll be interesting to see because obviously such a large increase, and if they were to get rid of the RSP shelter as well, would definitely change your sort of strategies, especially for people in the covered call and the yield max
Mhm.
products, like those ones that are yielding 60% distributions, like to get it cut down to 30 and not have the ability to shelter it would
Mhm.
be like a big hit for those people for sure.
There are some kind of nuances around eligible Canadian dividends, right? And I know
Yeah.
sometimes when you get our forms as well, like there are in the forms, they're specifically mentioned is what portion of it was from a Canadian eligible dividends and whatnot.
You mentioned eligible dividends, and it's good to make a distinction between the two. So in Canada, there's eligible dividends and there's non eligible dividends. So, sort of, the best way to explain it is this whole dividend tax system was designed to sort of avoid double taxation. So obviously, when you look at what a dividend is, it's a company sort of distributing some of their income to shareholders. But obviously, the company already paid tax on that income. So, like a company earns $100, they pay tax. Maybe they have $80 left over, and they want to give some to their shareholders. Their shareholders receive it, and then they have to pay tax on it again. So the way that the Canadian government sort of designed the tax code to avoid this is that when you receive a dividend, it's grossed up is the term, so that you basically increase you increase the value of the dividend so that it eliminates the tax paid uh, by the corporation. So it's like you had earned the income in the first place. It's basically eliminating the effect of the corporate tax to make it seem as if though you had earned the full amount of the income. So bringing that $80 back to the 100 and then charging you at your marginal tax rate. And then dividends are also given the treatment of a dividend tax credit, which sort of refunds you some of the money that you paid to make dividend investing more attractive. So like eligible dividends are usually paid by public companies and their income that was subject to the higher general corporate tax rate. And the non-eligible dividends are usually paid by private companies that are private corporations that are subject to like a lower tax rate. So the gross up for an eligible dividend is higher to sort of get that income back to the pre-tax corporate income. So that's the difference between the eligible and the non-eligible.
Mhm.
And then any sort of dividend income that you receive is going to be added to your taxable income. So if you're receiving a lot of dividend income in retirement, it'll push your taxable income up. It'll push you up into a higher
Higher
tax
brackets.
bracket,
Yeah.
higher marginal tax rates. And then, of course, that could impact your eligibility for certain benefits that are income tested. You mentioned the Canada Child Benefit, which is a good example. I would assume, I'm not 100% sure, but there's an OAS clawback for old age security where they claw it back and it's income tested as well. I would assume that dividends are included in that sort of threshold.
Mhm.
So if you're receiving a lot of dividends in retirement, that would impact that. And then obviously, if you have money in your RSP, the plan when you put it in your working years is that you get a deduction when you're making a lot of money to pull it out in retirement when you're not making as much money. If you're getting dividends and you're in a higher marginal tax rate, it might be that you're forced to pull out that money from your RSP at a higher bracket than you might have planned for
Right.
earlier in life. There's nothing wrong with making more income. Obviously, like I'm not going to tell you don't like you'd rather have a lot of dividends coming in retirement and maybe you pay a higher tax rate. So don't say like, oh, I'm not going to I'd rather make no income and pay no taxes because then that doesn't make sense. But it's something to consider for sure.
There are different tax tips or tax strategies, right?
Mhm.
Obviously, in Canada, we are very fortunate. We have several tax kind of advantaged accounts. What are those key considerations that they need to think about to differentiate
Yeah,
between the accounts and
for
which one to
sure.
go with?
Yeah, for sure. I can touch on a couple of those. So the biggest one, in my opinion, is use your registered accounts. Like they're there for you to sort of shelter your income. Don't not use them. I don't know if you want to take a guess. I looked at a BMO study. Do you know how many Canadians have TFSAs, adult Canadians? Do you
Is
want
it,
to take a guess?
well, my guess would be between 30 to 40%.
It's actually higher. It's 62, so
Okay.
it's a good
So,
thing.
yeah, yeah.
But the thing that surprised me is based on CRA data, only 10% of Canadians have their TFSAs maxed out, which obviously means that 90% of Canadians who have a TFSA have room to put money in there.
Hmm.
I know it's a lot of money to max it out. I believe if you're um, like if you were 18 by 2009 when they launched it, I think the most you can have in there is a little bit over 100,000. Now it might be 102,000. So
Hmm.
obviously it's a lot of money to put aside, and it makes sense that not everyone has it maxed out, but that opens up the door for people to put money in your TFSA. It's a great account. It's completely tax free. Anything that you earn in there, dividends, interest, capital gains, there's yeah, you don't get a deduction for putting money in, but aside from that, there's literally no drawbacks to this account.
Hmm.
It's nice too because if you withdraw money, it could be withdrawn and used for anything. And then if you are smart with planning, when you withdraw money, you get the whatever you withdraw, you get it back in contribution room the next calendar year. So what I like to do in December, I think about like, I have this money in my TFSA. Do I need any of it? If I need some of it, maybe the last week of December, you pull it out because maybe you need it in a month or two. You might need it in March for a purchase or something.
Hmm.
You wait a week and you get that room right back when the calendar year changes. So there's no drawbacks to the TFSA in my opinion. It's a great account and considering that 90% of Canadians have room to contribute to it, I think the easiest tax planning tip is to take advantage of it. We're afforded the registered retirement savings plan as well, which is a great account as well. It might be a little bit more, specific to some people. Some people it might benefit some people more than others. It also offers you the home buyers plan, which is a great perk to it too, which allows you to basically pull money out of your RRSP to purchase a home, your first home, and pay that money back over 15 years. It's sort of like you can look at it as a zero interest loan to yourself. So that's a great account. And then the FHSA was just launched recently, which is an excellent account. Obviously, it's only applicable for people who are looking to purchase their first home. And the CRA defines a first home as someone who's never owned their own home for the last 2 years. So if you owned a home in the past and maybe you've been renting for the past 5 years and you want to purchase another one, just because you've owned one in the past, you would still qualify. And FHSA sort of blends the TFSA and the RSP, where you get the tax deductions for contributions, and then all the funds are tax free when you withdraw to purchase a home. So it's a great account as well. I have a lot of information on Blossom, and obviously it's difficult to sort of give a full summary on all of them now. But my first tip for sure would be take advantage of all three of the accounts because they're they're great for saving and avoiding taxes legally in that sense. So that would be my first step for sure.
Those who are watching this video, follow you. Where can they get more information? How can they can reach out to you if they have questions?
Yeah, for sure. So you can find me on Blossom. My handle on there is Smart About Tax. If you join Blossom, I know they launched the web application the other day
Hmm.
as well, where you can sort of check out Blossom without creating an account. So if something that you're interested in, just seeing what the app's like without getting involved yet, you can find me on there. For now, that's the only real place that you can find my content. But for sure, if you have any questions and you're interested in learning a little bit about tax planning and even learning a little bit about investing, and it's something that might have intimidated you in the past, or you thought it's too difficult to learn, it's a great community for asking questions and just getting different perspectives. So you can find me on there, and I'd be more than happy to help anyone who has questions. Yeah.
That's fantastic, Matthew. Thank you so much as well again for spending this morning with us here, talking about some of the more commonly asked questions and sharing your wisdom, as well as for offering your services through Blossom. And I know a lot of our community finds a lot of value in what you're offering. So thank you so much for your time, Matthew. I
Thank
appreciate
you
that.
very much as well. I appreciate it.
Yeah, it's
Take
my
care.
pleasure. Have a good one.